Well, everybody, I'm glad that you're here today. As you can see, we're going to be meeting with Paul Asmar. Now, for those of you who aren't familiar with Paul, Paul's a professional trader with over 35 years of experience. He worked on the floor of the New York Stock Exchange for about 25 years, being awarded to trade for a number of companies throughout his career. In fact, one of the companies that he was awarded to trade for was Conoco, which at the time was the largest initial public offering in market history, or IPO. He is the founder of Camelback Trading 2742, a company that seeks to educate new traders. He provides market analysis, does live trading sessions, and gives professional consultation on the market at large in specific securities. Now that I've given you a little bit of background about Paul, I think it's good for him to introduce himself and give us some more insight into who he is.
Thank you, Louis. Well, thank you for inviting me. I love doing these type of things, especially with the younger people. I think it's great, like we were just saying right before you started, to get younger people interested in this field and in this profession. And it is a profession. It's not gambling. It's a profession. And to get them started at a young age and to have people try to learn the correct way is awesome. So I grew up in New York, in Brooklyn, New York. I went to a small college, downtown Brooklyn, St. Francis College. Graduated with a business degree and had no idea what I really wanted to do. I got a job. A lot of my friends got jobs in Forex, which is foreign exchange. I got into Cowan and Company's back office, which I absolutely hated. My wife's sister, well, she was my girlfriend at the time, but her sister was working on the floor of the New York Stock Exchange. Back then, it was who you knew rather than what you knew. There was a tremendous amount of nepotism and people who you knew. She hated it down there. So she was leaving. So I was fortunate that she said, do you want to come and interview for my position, which I did. And it was a very informal interview with the person who was her boss. But that's how I started on the floor. And I knew absolutely zero about the stock market. I really did. I loved sports. I was always a big sports person. Knew I was never going to be a professional athlete in anything, so I knew I better pick something other than sports. And I fell in love with this right away. Actually, the first week I was down there when I was learning, this was 1983, March of 1983, and my nose just started bleeding. It was just like from the excitement or whatever, it's a job unlike any other, where it's here and now. It's not, you can't wait for something for an hour or anything. It's like being a fireman, being in the military. Your job is on the line right then and there as you're trading. So I slowly worked myself up as a trading assistant, and then finally got my badge in 1993. Now I was with a very small specialist firm. So there's a huge difference to what you guys and gals see as a market today as to what it was when I started on the floor. So to put it in perspective, in 1983, when you wanted to trade a stock, we'll use one of our big stocks was Exxon before ExxonMobil merged. And we had gotten Exxon through the head partner of our firm being good friends with one of the Rockefellers. That's how that worked back then. But if you traded Exxon, 98 to 99% of the trades went through us as the specialist. We specialized in that stock. It wasn't like you can go to anybody else and buy Exxon. So, and there were no computers back then. So you called up your broker would walk into the trading crowd and execute Exxon stock with the specialist. If there was nobody willing to publicly bid or offer, that's where we put up our capital. Now, back in the early 80s, we were a very small firm. It wasn't as much trading as commission-based. It wasn't until, there was 64 specialist firms when I started, 64. There's 3 now on the floor of the New York Stock Exchange, 3 or 4. And they really don't do much anymore. I do more trading at home than they do down there. And I'm not saying that to make fun. A lot of them are owned by high frequency trading companies. So their algorithmic trading does more of the market making than the people on the floor themselves. Okay. So, I mean, if you want to ask questions, I mean, I can continue how my career evolved. You tell me what you would like, how you would like to do it.
Well, one of the next questions
Mhm.
that we kind of had prepared, we have a list here, is you gave us insight into how you first got involved trading. You didn't know a thing that educated you on the floor, and eventually you worked your way up. But once you got into maybe the mid stage of your career working on the New York Stock Exchange, what did your day to day look like? What were your experiences? What were your responsibilities?
Okay. So once I got my trading badge, so first of all, to get your trading badge, you had to prove to them that you were going to be pretty good at what you did. So first things first, a very huge defining moment in my career was basically the crash of 1987. Because in 1987, we was still half on paper books, half on computers. So I was the trading assistant in Compact Computer. Now, many of you will hear Compact Computer and say, that's like, that's a big dog in the computer industry. They're owned by Hewlett Packard now, right? But back in 1987, Compact Computer was one of the biggest growth stocks and up and coming stories on Wall Street. They were rivaling IBM at that time. So I was the trading, and the symbol used to be CPQ. I was the trading assistant in that stock for almost 6 years. And in those 6 years, we had the crash of 1987. Now, to put things in perspective, what I did as a trading assistant back then, so the specialist was handling the trading, but I had to know who was bidding, who was offering. We would have 10, 15, 20 people out in the trading crowd. And you had to know who were the buyers, who were the sellers, how much they had. And I was never good in real math, but in simple addition and subtraction, boy, did I get good at it. And I would have my boss, my broker, turn to me and say, 200,000 shares trade, and he's giving out 10,000 to this one, 20,000 to here. And by the time we finish out giving out what was happening, he would turn to me and say, okay, how many do they have left? And I better have an answer pretty close to the right answer for him. So you got really good at that. And during the crash, I'm not even sure what, I'm going to say Compact probably went from about $130 a share down to about 80. So you had about a $50 move. Now that doesn't sound like a lot today, right? Amazon moves $200, Netflix, Tesla. But back in 1983, to have a stock move $50 in one day was an incredible move. And even more important than that, your trades didn't settle until 3 to 5 days later. Now they settle within 1 or 2 days. So after October 19th of 87, when the market started rallying, if you had a trading error 3 days later, it could literally be $30, $40, $50 against you and cost your firm a lot of money. Well, I was very fortunate. I was very good at what I did, proved my worth being the trading assistant. So eventually I got my badge. So I had to take a test. There were 2 tests I had to take. I had to take a broker's test and a specialist test, since I was a specialist. I didn't need the Series 7 or any of those other things that now everybody needs. But back then you needed those 2. Now, once I got my badge, I'll tell you what, the difference between standing behind the trading post and standing, it was only about a foot wide, and standing on the other side and having that badge on, the responsibility was incredibly immense, because now you were making the markets in those stocks. So my day-to-day was, when I first got my badge, I was called a relief broker. So I would go into different panels that we had when people took a break. And as a new specialist for the firm, they wanted you to get to know every one of your stocks in the firm, which was a good thing. Once you were able to do that, then you got your own panel. And it was like a little storefront. So I would get 5 or 6 stocks that I would trade, and I would be responsible for making a market in those stocks. And you had a lot of hats to wear once you did that. You had to please your companies that you represented. Remember, I was the only one representing. So I traded Bell South, was one of the baby bells. We had Wells Fargo, and Wells Fargo was a very high flying stock. We had Toys R Us, when that was also a growth stock. So I would make markets in these stocks. So I would be calling the CEOs, CFOs probably once a week because they want to know why their stock was reacting, how it was, what I was doing to provide liquidity and dampen volatility. So I had to please my companies. I had to please the brokers on the trading floor that I dealt with. I had to please my firm because I had to make money trading these stocks. So you wore many hats doing that. So that was the day-to-day operation.
And when I was looking through your website,
Mm-hmm.
Camelback Trading 2742, I noticed a section where you took a picture of the medallions that you had been awarded while trading on the floor. And you said that these were companies that had awarded you to trade for them. Can you walk us through what that process is like, what it means to be awarded to trade, and what you do once you are awarded to trade?
Absolutely. So my firm, we were a very small firm. A lot of firms after 1987 realized they didn't have enough capital. And a lot of the bigger firms started eating them up. Well, in 1996, part of our firm, we were three parts, my small firm. Part of our firm joined a firm called Spear, Leeds and Kellogg, which was the largest specialist firm on the New York Stock Exchange. And we got a lot more exposure to bigger stocks, but also more importantly, we got exposure to a lot more money. Boy, could we play now, because we went from maybe 20 to $50 million worth of capital to over $1 billion with Spear Leeds. And then eventually with Goldman Sachs in 2000, it became pretty much whatever you wanted to play with. So specialist firms got rated. And by that, I mean, the way I said I had to please everybody, all the other floor brokers, so Merrill Lynch, Bear Stearns, Smith Barney, JP Morgan, those brokers rated us on our performance every quarter based on how we dealt with them, just everything, how we made markets. Then we had statistics. We didn't just make markets when we wanted to. You had a guideline for every stock based on the stock's volume, based on the stock's price. So you had to adhere to guidelines, and you had to do better than the guidelines. So then you had a selection committee. So it was very competitive in the 90s. We still had about 35, 40 specialist firms, but they would only pick between 3 and 5 specialist firms that were the highest rated to go for those interviews for these new companies. And then once Spear, Leeds and Kellogg was picked, then it was up to my firm to pick which broker they wanted out of us to go represent them. So we went from a small firm of 10 specialists and 20 assistants to 100 specialists and 250 assistants. But I was fortunate. I was one of their specialists that they had go and interview for them. And Conoco was one of my first big ones. They were spinning off from DuPont. They had been a public company once before, but they had been taken over by DuPont, and now it was the largest IPO. And I had to go in there, and it's kind of daunting to sit. It was me, one of the senior partners in the firm, and somebody from our corporate corporate relations. But across the table was the CEO of Conoco, the CFO of Conoco, the treasurer, and they're looking at you saying, "Why should we pick you to represent our stock?" And you basically laid it out to them. You tried to be as honest as possible. How working with Spear, Leeds and Kellogg, with the amount of money we had, that the depth we could provide, the liquidity we could provide. One of the big things I think that I stood out on from a lot of specialists was I didn't just look at Conoco as a stock. And I always looked at it as there's thousands of people working for this company. So it's more than just a stock to me. And that appealed to these people. And I was very fortunate to get allocations because of that. And it wasn't just like a line that politicians use, we'll lower your taxes, and you never hear that. Because once I did get the stock, I spent many days. I spoke to my companies almost every other day from like 1996 to the end of my career. I spoke to a lot of the CFOs every day. I made it a point to go visit them. I flew out to all my companies once or twice a year to go visit them. I went to Conoco at least 2 or 3 times. In fact, I was ready they were going to fly me out on a helicopter out to one of their rigs in the Gulf. And then they got taken over by Phillips Petroleum. So that didn't happen. So usually when a company gets taken over, if you're the one being acquired, that specialist loses that stock to the other specialist who has the company doing the acquiring. Not all the time, but usually. So I lost Conoco, unfortunately. But I have a great letter from the CEO. The day that they left, they said they would have liked to have stayed, but it was out of their hands. So that's those medallions. And I have a bunch of them. I'm going to say I probably went for about, 12 or 13 interviews. And I probably got awarded maybe 10 of the companies that I went for. There was a lot of smaller ones. There was marine drilling. There was in the oil industry. There was Hospira, which was a spinoff from Abbott Labs. Tom Brown Industries. Vizex. They did the LASIK surgery. They were coming over from the NASDAQ. Bay Networks, which was another huge rival of Cisco company. So I got a lot of these companies, which was good for me. The bad news is a lot of these companies got taken over my career, but that happens. So that's the interview process.
Thank you for that. And
Sure.
One of the follow-up questions to that, since you were talking about Conoco,
Mm-hmm.
if I'm correct, Conoco, you worked for them or traded for them during their IPO. Is that correct?
Yes. Mm-hmm.
So talk to us about what it's like trading on IPO day, how it's
Sure.
different from any other day in the market or any other day of trading for a company, and just
Absolutely. So the most difficult thing when a company's going IPO is where it's getting priced. Now you have all the analysts. Now back then we still had what we called the banker, the one who was the banker for the IPO. So Morgan Stanley was the banker for the Conoco IPO. Nowadays you get a lot of direct listings. You don't even have an underwriter, but or sometimes we used to have 2 or 3 underwriters. But Morgan Stanley was the big one. So the stock got priced that day. Now remember, it was an oil stock, so I didn't expect it to be priced and then trade very much out of its range. I'll go over another one that really did. So Conoco was priced, I believe, at 24. Now we were trading, remember, we went from 1/8 of a dollar, which is 12.5 cents, to 1/16, which was 6 cents, to pennies. So when Conoco went public, we were trading in steents, it was called. So it opened at 24 and 14/16 steents, which is 7/8 of a dollar. It took people a long time to figure it out. They used to walk around with the card to figure out which each 16th meant. So we opened it. What we did was, whenever a company opened, you always had the CEO come in and buy the first share, and then we would price the stock. Once we knew where it was opening, he would buy the first share. So we opened the stock at 24. And the reason I know this is I have the ticker sitting in one of my offices with the initial price, which is pretty cool. So the stock opened. Once it opens, when you take a stock public and you open it, you certainly don't want to see the stock fall out of bed. So that's where your responsibility was huge, and the underwriter, which was Morgan Stanley. So that kind of traded in a pretty tight range. I mean, it was, I was running the trading crowd. We had another broker just running the trading book because we're all on computer, because you literally had 30 to 40 people in the trading crowd. So one broker couldn't do it. So we had a bunch of us doing it. And the goal was to have liquidity, provide depth in the market, and just make sure it's an orderly market. So that was a fairly easy one. One of the toughest IPOs I ever did was the Chicago Board of Trade. And that was one of the last stocks I ever took public towards the end of my career. That was in 2005, I believe. Now, this was not an oil company. This was an exchange. And we went up to the breakfast. We're sitting at breakfast. We always had the opening breakfast. So I tried to get down to the trading floor by 9:05, 9:10 to see what was going on. Well, the stock was priced at $56 a share. I had bids all the way up to $90. I'm like, well, this stock's not opening at $56. So when we opened, we finally, most new stocks you can't short right away. And you obviously understand what shorting is, right? Where you're selling the stock, and then before you own it, you have to borrow it to buy it back. So an IPO, there's no way to borrow it from. So the only one who could short on an IPO back then was the specialist. We had to be able to short. Okay? So we opened the stock, I believe, at $86, $30 above the IPO price. And I shorted maybe 250,000 shares because I had to. There's nobody else to sell it. Well, it went from 86 over the next couple of days to about $124. So I was down. That was October of, I think it was 05. So within a month, I was down almost $4 million because there was nobody else that could sell the stock. So we had just had to continually short it. So now, luckily, by the end of the year, that year, it had come in. I got most of that money back. I think we lost like $750,000. Now, the firm doesn't blame you for that. I mean, that's part of our function. You have to make a market. Whether if the stock's down $40 or up $40, that's what we're there for. So the Conoco one was an easy one. I could get in and out of 250,000 shares in a heartbeat because it was a very thick stock. There were a lot of bids and offers. But in a stock like Chicago Board of Trade, there weren't. It was a very illiquid stock. And that's why there was so much volatility. And that's obviously a lot more dangerous when it's going one way. And you see that today now, right? You see Tesla, the Apples, NVIDIA, but there's no market makers now. Those are algorithms. So that's that on the IPOs.
So what would you say are some of the biggest misconceptions about Wall Street? Being a person who has, worked at the New York Stock Exchange for decades and, having an insider perspective to Wall Street, what would you say are some pretty standard beliefs about Wall Street that are really just misconceptions?
Well, one misconception is everybody's a billionaire. That's number one. People work very hard down there. I mean, there were close to 6,000 people on the trading floor at one time when I was there, 6,000. And now there's probably less than 500. It was a great community. Yes, people made a lot of money. And just like any field, any industry, there were bad guys, but the majority were good. Eventually, bad brokers and specialists got caught if they were doing things illegal. But I think a lot of times Wall Street gets painted with a brush of, they're all thieves, which is really far from the truth. It was the most generous place you'll ever find. If anybody's, child or anybody had an issue or whatever, they'd walk around with a huge garbage can back in the day and fill it up with $5,000 to $10,000 in literally a half hour. People just throwing in 10s and 20s and things like that to help people out. So I think that's something you never really heard about the good. You see these more, Wolf of Wall Street, all these movies, the original Wall Street with Michael Douglas. You see the greed of it, but, and yes, there is greed. Don't get me wrong, there is. But I think there's, I never thought I did something that really meant something. And by that, I mean, being a doctor to save a life, an engineer to build something, a fireman to save lives. So, all I did was try to make money and make markets for my firm. But I'll be honest with you, now that I work behind the trading screen and I see the volatility in these markets, I can honestly say I feel really good about what I did for my whole career down there, because now it's just the Wild West out there. So it took a while for me to accept that, but I think I did do a lot of good down there.
So thank you for giving us some insight into that. Follow-up question is, what do you think are some of the biggest misconceptions and or myths about trading or being a trader?
Number one, I've been doing this, from being a specialist and now behind the screen. I've been behind the screen now. So I left the end of 07 when the writing was on the wall that we were really all going electronic. I didn't really start working behind the screen, which we call it, till 2010. I had a horrible start because I still thought I was a specialist. So every time the market went down, I went long. When it went up, I went short. And I didn't have to do that anymore, especially when it's my own money. So that was silly on my part. I finally sat down with somebody, a good friend of mine who worked, he used to trade the oils, but he had been working behind the screen since 1998. And he started, I don't know how many of you guys have ever heard of the market profile. It's an awesome little tool to put in your arsenal. And I sat down with him for almost all of 2011, and he taught me it. And then from that point on, I started using that. Still took a while to grasp. The biggest misconception is trading is easy and it's not a job and it's gambling. It's none of those. It's incredibly hard. I've probably worked harder now than I ever have in my life, especially I'm trading my own money. So right off the bat, even though I was trading the firm's money and I had to make money, otherwise they wouldn't keep me, it's still a difference trading somebody else's capital and trading your own. That's number one. Number two, your mental reserve is just as important as your capital reserve. So if you blow your mental reserve at 9:40 in the morning, you're going to have a tough rest of the day. So that's something that people have to take into account. I tell everybody in my trading room, the three things they have to know. Number one is themselves. You have to know yourself. What kind of a trader are you? Are you a scalper? Are you a swing trader? Are you a longer term trader? So you have to know yourself. Then you have to know your competition. Who are we trading against? And then third is know the product you're trading. I only trade the SPY because when I sat down with my friend back in 2011, he goes, all right, how many stocks you want to trade? I said, I don't know, 5, 10. He goes, by the time I get through with you, you're going to want to trade one. And I looked at him like, why would you say that? And then after everything he showed me, what he puts into it and how we look into things, and I'm talking about day trading. I'm not talking about investing. That's different. But as far as day trading, I just trade the SPY because the homework I put into it on a daily basis, having to focus on it, watching the market profile as it evolves. Trading is an art. It's not a science. 1 + 1 doesn't equal 2 in trading. It just doesn't. It sounds silly, but it doesn't. Trading is an art, and you have to focus on it. And that's why, I took the SPY and learned it like the back of my hand. And I took the SPY for a couple of reasons. It's the best barometer of the overall market, right? It's the S&P 500. It has great liquidity. It has great volatility. So those are the things that I'm looking for in a stock. Now, I can trade other stocks. It's not that I don't look at other stocks. And a lot of people in my room are always asking me to look at Apple and Amazon and Tesla. And I'm looking at them, but I could break those down for anybody on the chart. But it's not the same thing as me breaking the SPY down on the market profile and the chart. I have reference points and destinations that go back to 2013, back to $150 in SPY. You have to set yourself apart from your competition. So I think those are some of the key things as far as people trading and what they have to know.
So a follow-up question of that, given that you're talking about how you specialize in trading SPY, representing the S&P 500, you think it's a really good, reflection of the market. The question I would ask you is, do you think that traders should avoid trading multiple different securities or just many different kinds of financial instruments? Should they focus on one thing rather than thinking that they can jump into anything that looks, good or appealing?
Well, it's a tough question for this reason. If you're day trading, I would say yes, it's hard to trade multiple things at one time. I know a lot of people want to just be momentum traders and they just try to jump on the momentum side. And a lot of times that does work. But these algorithms are ruthless now. We trade 95% of the time against short-term day traders and algorithms. And they are absolutely set and designed to go to very visual reference points and destinations. And if you're trading 3, 4, 5 different stocks, and this isn't just in the SPY they have this set, they have it set in all these stocks. So if you're trading Apple and NVIDIA and Amazon, if you don't know these destinations and reference points and you're just trying to jump on for momentum reasons, this and that, yeah, you might, for the most part, get lucky doing that. But at some point, you're going to probably get hurt pretty good. Now, if you're investing or you're taking a bigger picture, if you're taking a swing trade, if you're looking out a week, out 2 weeks, then yeah, you can break down those things on the charts and get a better picture of it and trade more than one. But as far as pure day trading, now again, this is me. Everybody's different. Like I said, you have to know yourself. Maybe people would be capable of doing 2 or 3 stocks at a time, with if they put all that work into it. I look at the triple Qs a lot. I don't really trade it. A lot of people in my trading room trade the Russell, the triple Qs, the NQ. So I do look at them and break them down. But the only one I trade on a daily basis is the SPY. I have success in it. I don't want to change what's broke. The only thing I might change, a lot of my room trades the futures. So they bust my chop saying, why don't you trade the futures? And the reason is because I was always an equities guy. I never traded futures before. I was a market maker in stocks. And when I went behind the screen, I started trading stocks. So that's why I trade it. And I trade the options in SPY because it's so expensive. If you buy 1,000 shares, you're putting up $330,000 worth of capital. I don't want to do that, but I could buy 10 calls and I'm putting up a lot less, and that's the same as 1,000 shares. So the reason I trade the options is because I get a lot more bang for my buck. So it's, again, if you're day trading, I would say stick to 1, 2 stocks. If you're in a club like you and you're breaking down balance sheets and this and that, those type of things, then it's a totally different story, and you can look at more than 1 stock.
I think that's something that a lot of the members here are interested in, maybe even confused by, is how you talked about when you used to work on the floor of the New York Stock Exchange, it really was a person-to-person market, whereas now you say the market is mostly dominated by algorithms. And I think that a lot of people don't know really what that means, what these algorithms are and how they do control the market.
Okay.
Could you talk a little bit more about that, what the algorithms are and how they play a role in the market today?
Absolutely. So exactly what you said back in the day, if you wanted to trade my stock, your broker, JP Morgan, would come in with 100,000 shares of Exxon to sell. And he would have that order in his hand, and then he could either stand out in the trading crowd and represent himself, or he would entrust me with that order, and I would be called working that order for him. And he would tell me, hey, look, here's 100,000. You had a good rapport with most of these guys. There were some real tough people out there. They would come in and say, what's the bid in Exxon? I'd give him a bid, and he'd go, sold. Now, meanwhile, if he just sold 100,000 shares, I might have bought 50,000 in my own account out of my firm's money. And then as soon as I made that trade, he'd go, okay, I have another $250,000 for sale. Make me a bid. Those are the guys that we didn't get along with too well right away, because most guys worked hand in hand. Yes, he can hurt me, but if he hurts me, eventually, I run the stock. I know the stock. You want a good rapport. So most guys would come in and say, here's 100,000 shares. I have another 1 million behind this. So if you're making me a bid, be careful if you're putting up a lot of your capital. And that was very nice. We worked both sides. Also, if you had, say, all of a sudden 3 sellers show up in your stock. No news out, no nothing, but 3 sellers of size show up. It was my fiduciary responsibility. I couldn't just take that stock and say, okay, all 3 of the sellers, down $1, you could sell everything. I had a duty to get anybody who was a buyer in that stock, even if it wasn't that day, but maybe you had a guy who was a customer who was a size buyer for the previous week. So everybody's badge number, we had a beeper where you just type in their badge number and they come to your trading post. So that's what I would do. I'd say, okay, so somebody from Goldman Sachs comes in and say, well, I have 3 sellers here. They're looking for a bid. See if your buyer from Friday still has an interest. He might come back 2 minutes later and say, yep, my buy is here. What do you want to do? Let's put a nice big piece on. And we put on 3 million shares, down $0.25. Goldman Sachs buys a lot of it. Whoever my public bids are buys a lot. And then I buy a lot for my firm. That's matching buyers and sellers. That was the function of what we did. And it would dampen volatility. So the stock wouldn't move down $1 and then go right back $1. Now let's go to today. If 3 sellers show up in Exxon, every algorithm that was buying it will run away, and Exxon will get, and Exxon's a bad example because that's an oil stock. It won't move as much. Use Apple as an example, or Tesla, any of the tech stocks. Anybody who is buying as an algorithm, once they see these orders flood the system on the sell side, they just walk away. And that's why you see a stock rip down $1, $1.50, and 2 minutes later, right back to where it was. So these algorithms, now long-term players use algorithms also now, but they do it in a much more orderly manner. So in other words, if there is Fidelity wants to sell 20 million shares of Apple today, he's not going to go in and just start hitting every bid in sight. They take Apple's daily trading range over the last month, their average volume over the last month, and they start feeding the order based on those parameters into the system. And as long as Apple isn't moving a lot, that's how you won't even know that Fidelity was selling 20 million shares of Apple. You won't even know they're in there. However, and we like to call it long-term sticky money, when the market, like for argument's sake, the market doesn't like uncertainty. If there's no clear winner in this election, then there's a good chance you're going to see this market sell off. I think no matter who wins the election, the market will breathe a sigh of relief if there's not a lot of uncertainty after tomorrow night. But if there's uncertainty, then everybody is going to probably, at least initially, start flooding the system to sell. And there's nobody there to make markets anymore. So the way I said, well, somebody's going to put their orders in orderly in Apple, well, maybe not Wednesday morning. Now they'll say, sell $1 million. So now it's not only Fidelity, it's Putnam, it's this hedge fund, it's that hedge fund, it's the teachers union. I want out. And all those reference points I talk about that I keep, when you're dealing with short-term traders, they stop at those very visual levels. Long-term money won't. They'll just blow through everything like we saw in February and March. So there's a huge difference between how the market traded back when you had human intervention and now.
So a follow-up question here is, we've had a couple people say in the chat, just kind of an obvious truism that everybody knows, which is that very few people who call themselves traders actually make money. And I wanted to give you a chance to talk about the risks of trading and some of the reasons why you think, as we call people traders, very few of them make money, including, internet trading, which has become very popular today. You obviously having 25 years of experience, then re-educating yourself for years, and then starting to invest your own money, obviously having that background, you can, I think sufficiently call yourself a trader. Whereas many people today look at a YouTube video, throw some money into a Robinhood account the next day, and are disappointed that they didn't make money and that it wasn't as easy as they had seen elsewhere. So I wanted you to give some insight into the risks of trading and what really makes for a well-educated trader.
Sure. Well, the risks are huge. And I'm not saying this to discourage anybody, because I know all of you in there in investment club. But the fact is probably 90 to 95% of traders fail. But that number could be lowered by a lot of different things. Even my industry, when most people left the trading floor, this is all we knew how to do. So everybody tried to day trade. I'd say now I'm off the trading floor since the end of 2007. So it's 13 years for me. I'd say at best 5% of people who left the trading floor around me around the same time still trade. It's not an easy thing, but there are things, and that's a huge thing in my room. What I try to stress is to teach people. So why aren't people successful? Because people want to just hear somebody on Twitter yell, sell will come, or this or that, and so they'll sell it. And meanwhile, that person on Twitter knows nothing. They have no idea what the concept of market-generated information is. That is the entire premise of how I trade. MGI, market-generated information. I go home flat every night because I'm a day trader. I'm not an investor. I want to be unbiased when I walk in tomorrow morning. I don't care if the market goes down 20 points tomorrow, up 20, because I'm flat and I have a clear head. Market-generated information will tell me basically what I should be doing. And what do I mean by market-generated information? That's when a market, say for argument's sake, Wednesday we open up and start going straight down every half hour. We trade in half-hour time frames, so 9:30 to 4. You know how many people try to fade a trend day. And what that means is the market's down 3. Oh, we got to stop here. I'm going to buy it. Market's down 7. I got to buy more. Market's down 15. The SPY's down $15. Can't go down any lower. I'm buying more. That's called fading a trend day. That is the biggest career ender ever. Now, everything I say in here, and this is what I tell my trading room, I've done. I've faded trend days and got killed. You better learn from that. So the biggest thing is not getting out of a loser. So if I'm long or short a stock or the SPY, and now my market generated information is telling me my trade is wrong, I have to get out, because the next biggest thing to blow up trading accounts is letting a loser run and taking a winner off too early. And I've been doing this my whole life, and I still struggle with that. In fact, I tell my trading room, I want them to hold me responsible when I'm in a trade and it's going my way, not to get out of the whole thing. Because, when you see the P&L go green, it's a lot easier to say, well, I'm going to take this off. And that's all well and good. But if you're going to take your winners off too soon, but let your losers run, that's a recipe for disaster. So trading is not easy. Like I said, I try to be as honest as I can to my room, otherwise I'm lying to myself. It's not easy, but the odds can certainly be better than they are now for a lot of traders if they take the time and effort to try to learn the right way. That's huge.
So something I wanted to ask you about is something that honestly I'm not very familiar with. I'm sure many people here aren't very familiar with. You talked about how you learned to read a market profile, and you make a lot of your trading decisions based off a market profile. A question I had earlier is, do you use any simple technical indicators that a lot of traders are familiar with, like a simple moving average, MACD, that kind of stuff? Or do you focus on this market profile exclusively? And what really is the market profile? How do you go about interpreting it?
So if I had my other screen up, I could have shared it with you on it. The market profile is basically a very visual tool that paints a picture as the market's evolving. So we start at 9:30. From 9:30, we call it A period. It goes from letter A through letter M. And it's a 30-minute bar chart. So this is how I like to explain it. A 30-minute bar chart is like an X-ray. A 30-minute market profile is an MRI. It tells you so much more that I couldn't even begin to get into here, explaining the different terms and things that I look at that help me trade using it. Now, do I use other things? Mostly not. I know where to fit, a lot of people use, everything you mentioned, and anything that works for anybody else, I don't have any, people should use it. I have found the profile will basically tell me everything that's in all those other indicators for the most part. I do look at the 50-day moving average and the 200, not because I think I want to be a buyer at them, but so many people look at them that I have to know where they are. It'd be silly not to know where they are. A lot of people use that 144 short-term moving average on a 1-minute chart. So I know where that is. I don't trade off of it, but I certainly know where it is. A lot of people in my room, they do use all those things that you say. And a lot of times what they're seeing kind of jives with what the market profile is telling me. And that even gives me more confirmation. So the short answer is I use the profile, I'd say probably 95% to base my trades on. It basically paints a beautiful picture on how the market evolves. I wish I could show it to you. It's easy. You guys can, there it is.
It's kind of an example image of what I found on the internet.
Right. Now that's not a great one.
Yeah.
Now the guy who does it, Jim Dalton, again, he has a lot, and this is cool for traders to look at. So Jim Dalton, he's written 2 books. He's the godfather of market profile. In fact, the fellow that I learned from knew Jim he flew out in 1996 or 7 to Chicago to take this class with him. Jim, that's him. Jim, he charged like $2,000 for a week-long session. Now he charges like $12,000 for a live session for a full week. He's getting older now, but there's a lot of free stuff on the internet. He has 2 books, Markets in Profile and Mind Over Markets. So if you guys are interested, you should look at that. He has a lot of free stuff on the internet. You don't have to buy, I have the book. I use Markets in Profile kind of like my Bible next to me. It's something I always refer to. But even that, I believe, is free on online now. So it's something for if you're interested to look at. So I also do, well, I'll give later. I have a YouTube channel and a Twitter thing that's all free that you guys and gals could look at. You care if I give out what my info is for that?
No, of course.
So my let me write here. So my YouTube channel is under my name, and you'll see all the market profile trading. Why is that saying? Am I sending something to somebody privately? Did everybody see what I just typed or no?
Oh, I don't think so. I think it may have sent to somebody privately. What you can do is click where it says the name of the person you sent it to, and then click everyone.
Why don't I see everyone? Let me see. Chat. Here we go. Oh. Are you still there?
Yeah.
All right.
Here, let me do this because I think this may be it. Yeah. Is this your YouTube?
That's it. That's my YouTube. So I do a video at 9 a.m. to say what I'm looking for in the video, looking for in the market. And then at 4 p.m., I do one, I go over all my trades. I go over all my trades, why I took them, what I'm looking for, and then I break down the charts. And that is the market profile I use. So it's kind of cool to look at. And then I have my Twitter account is same thing, my name, Paul Asmar, at Paul Asmar, one word, and the number 5. So if you want to follow me on Twitter, here it is. So I love, I love to get people following me on Twitter, YouTube. It's great. So, yeah, and thank you. I appreciate that.
Of course. I know that you probably have some limited time. I'm sure you have many other things to do, but some of the final questions that we have, one of which is,
I'm fine with time. So.
Okay, perfect. What would you say was your most exciting experience, maybe your most exciting day while working on the floor of the New York Stock Exchange?
Oof, there's a lot. I mean, it's, well, a couple of special ones. Well, that day in 1987 was incredible. I mean, getting my feet wet like that. 9/11 was not a good day, but it's an experience I'll never forget. I walked through those buildings a little bit over an hour because I lived in New Jersey at the time. So I used to drive to Jersey City and then take the PATH train over to New York. So I walked through those buildings every day. So that day was incredible, eerie. The following Monday, right, the exchange was closed from Tuesday through Friday, the rest of that week. And then Monday, I couldn't get to work the same way. I had to take a ferry now. And then walking up Wall Street that Monday, there was literally a tank, an army tank, blocking off Wall Street, and nothing but armed soldiers, walking around. And that was like a very, very weird and eerie thing. You knew the world had changed at that point. So obviously not a good memory. But then after that, probably for a year later, we had first responders walk on the floor every day to ring the opening bell and every day to ring the closing bell. Firemen, police, every first responder you could think of, which was pretty awesome. So that was nice. I met George Bush, the son, twice came down on the floor of the exchange. Once was expected, once was unexpected, which was really rare because when you knew a president was coming down, they would basically sweep the building the night before and keep things totally clean. But the second time he came down was kind of a surprise, which was pretty awesome. And he came right where our trading post was right by the front door of the floor of the exchange, and he walked in there, and it was pretty cool. So that was really cool. Every day was a thrill down there. We met so many athletes that would come down at the Stanley Cup, the Super Bowl, supermodels, you name it, actors, actresses. It was pretty cool. I know that the other fellow in here who's Lebanese, so Danny Thomas, who's Lebanese, came down to the trading floor. And you guys probably don't even know who he is. He's an old-time actor. But I got to meet him. Actually, must know his daughter, Marlo Thomas. She's involved with St. Jude's, which is a big thing that I'm involved in, which is a children's hospital. So
Danny started that one.
Yes, he did.
Yeah,
he did.
St. Jude's. It's amazing.
Mm-hmm. So that was pretty cool, pretty special. But there was a lot of cool things. We met a lot of famous people and whatnot down there. So there isn't really one special day. I guess the real proud days for me were my IPO days. Those were really proud days when I did Conoco and Chicago Board of Trade. Those are two of my biggest ones. So that was pretty cool. And I did a commercial.
Yeah.
Did any of you Cisco Corp, obviously. Everybody knows Cisco. But back in the late 90s, anybody hear of Bay Networks? They were Cisco's rival. And they asked me to do a commercial. So we filmed 6 hours worth during a trading day. And I was in the commercial for exactly 3 seconds after 6 hours of filming during the Super Bowl that year. So that was pretty cool. And then they got taken over by Nortel Networks.
I know that you're a huge sports fan, so that must have been a moment for you to see yourself on a Super Bowl.
It was pretty cool. I have a video of it, but I thought I'd be in longer than 3 seconds, but it was pretty cool.
So, Paul, another question I have is, as all of us know here, market hours are Eastern time, 9:30 a.m. to 4 p.m.
Mm-hmm.
What period of the market day, including pre-market, if you trade pre-market, do you devote to trading?
I trade, well, since I trade the options, unfortunately the options don't trade before the opening. They trade from 9:30 to 4:15, which is pretty, in this day and age, especially some of the major ones like SPY, they should trade whenever the SPY is trading. Because SPY trades at least to 8 o'clock at night. Some exchanges even have them trading throughout the night. Not that I would want to trade all night. I would not. But I would like to have the opportunity. Like tomorrow night's a perfect example. I can't trade the SPY after, I could trade the ETF, but I can't trade the options after 4:15. Well, if there's a reason that I would want to get involved, if the election is pretty much called one way or the other, or it is going to be a very tight race and there's going to be uncertainty and the market might want to sell off, I would like to be able to trade options then, and I can't. So I do trade. I trade 9:30 to 4. Trade all day. I don't go looking for trades. That's another thing that gets traders in trouble. I let the trade come to me. I'm looking for my setup based on market-generated information. If you do 20 trades a day, your odds go down. If you do 5 or 6 trades a day, your odds are better. So, but a lot of people in my room, they trade all day and then they'll trade at night. But I also have a lot of people from I have all over, from Costa Rica to Belgium, the UK, Germany, Switzerland, you name it. I have a lot of people in my room throughout, which is pretty cool. So, but I trade 9:30 to 4.
Well, Paul, that's the last of the questions from me. I want to give a chance to the members to ask questions that they may
Absolutely.
have. It looks like Jeremiah just asked in the chat, what kinds of options does he trade? SPY options, right?
So I trade the SPY options, and I base those, Jeremiah, based on where the stock's trading. So I usually play the same day expirations. Like, so today I played Monday's expirations. Tomorrow I'll play Wednesdays. I usually play in the money. So if we're trading at 330, if I'm buying calls, I'll probably buy like the 328 calls. If I'm buying puts, I'll buy the 332 puts just to give myself some room.
Enrique Salazar just asked, what do you think about penny stocks or trading penny stocks?
Never traded them. That's, for me, I would not trade them personally. There's too many good stocks out there. If you really want to learn to trade, I would stay away from penny stocks. I know they look inviting, especially for people maybe with smaller accounts, but I don't trade them. I never did trade them.
Benjamin Reinhardt just asked, what do you think about trading Bitcoin?
Again, never traded it. I don't, like I said, I have to understand what I'm trading. I don't understand Bitcoin. It's just something that's out there. Yes, it might become a very viable thing. But for now, until it gets really regulated, I have no interest in it. That's me personally. A lot of people in my room do trade it, though.
It looks like Jeremiah just asked, is there something wrong with trading future in forward? Future.
Is there something wrong with trading future?
Maybe there's a typo here.
I don't trade gold or silver. I do once in a while have traded the GLD, which is the ETF for gold, but not recently. As the stock is approaching a price level you're interested in, what are you paying attention to? Well, Darian, I'm looking for a lot of things. Based on the market generated information I'm getting, if like today was a perfect example, the market rallied later in the day, and I was like, I don't mind taking a short position here. I think these were just shorts covering. So I looked at a level. It got to the level I wanted to. I took that short play, and it backed off. So those are the things I'm looking for. When I take a trade, I usually have destinations in mind that I want them to get to. So when I take a short trade, I'm looking for it. And again, these are terms that a lot of you probably won't understand. But I'll look for the point of control, which is the longest part in the trading day, where buyers and sellers are happy to do business in. So if I take a short at, for argument's sake, $331, and at 330 and a half, that's where most buyers and sellers are happy to do business. And we know that because the volume's the most and it's the largest part in the profile. That's a destination I'll look for that to go down to take my short off. So those are things I'm looking at. Let me see, contracts. So let me just see what that other person asked. What did he, where is that?
Yeah, I think he was asking about trading future contracts, forward future.
Well, again, I have done swing trades in the past. I might actually do one tomorrow. So tomorrow, I'm actually thinking, we close, where do we even close? I forgot now, I shut my machine off. 330 and change, 331. If we're trading around the 330 level, I might do what's called a straddle and buy both the 330 calls and the 330 puts tomorrow afternoon. Thinking, and I'll do that not for tomorrow's, Wednesday's expiration, but for Friday. Thinking that we're gonna have major volatility, so I should get something out of that one way or the other. So in other words, I'm saying, I'm thinking by Friday we're trading at 300 or 300, or maybe we're back to the all-time high. So if we're trading at 300, yes, I'm losing money on the call, but I should be doing really well on the put. So that's something I might think about. But for the most part, I just trade it, day trade it. I don't pay attention to the Greeks because, Benjamin, I'm trading the option because it gives me more bang for the buck, okay? And not because I'm worried about it losing value. In other words, if I take it, like today, I took a 331 put. We were trading at 329 or 330 and change. I thought the odds of going back down to that level where I talked about a couple of minutes ago was good. So I don't care about the delta or any of that at that point. because I'm looking for it to just get down to that level. I'm not sophisticated in options by any stretch. I use them because I'm able to play a lot bigger. I mean, I'll take 500 to 1,000 contracts if I think it's worth it. What are your thoughts on algorithmic trading? Do you think that human traders will be unable to compete with them? Well, that's a great question, but Nicholas, here's the thing. I'll never be faster than an algorithm, but I can be smarter than an algorithm. So that's why the market generator information, as it's setting up a trade for me, I will be ready to take that trade so I don't have to be faster than the algorithm. Plain and simple. That's it. We're never going to be faster than them. We have to be smarter than them. And these short-term algorithms aren't smart. They're put in there by quant guys who are very good in math, but not very good at trading a lot of times. And they set them to these very visual levels. Well, if I know these levels, all I have to do is be smarter than them and not quicker than them. So, what other books do I recommend? Well, definitely Markets and Profile and Mind Over Markets by Dalton. Mark Douglas is another huge one. And I can't think of the book. He has a free 4-part series, and he passed away actually, but this is a while ago. But Mark Douglas, I forgot the name of the book. Darian, do you know it? Darian might know it, the name of the book.
Yeah, it's Trading in the Zone by Mark Douglas.
Thank you. There you go. So that's a good one, Trading in the Zone. Or any of the books he has out there. From thoughts on trading option when companies releasing and after. I do not take a position prior to an earnings report. I will trade. Now, again, I only trade the SPY, so earnings don't affect the SPY as much. But if you're trading individual stock, again, if you're using market generated information, I wouldn't have a problem trading a stock after their earnings. VIX, you can buy a call on the VIX if based on the volatility possibly for this week. I think the VIX is the most manipulated thing out there with its reverse splits. I hate the VIX. I did very well on it one time, got burned on it another time. So I basically stay away from that. But yes, you can buy a call on the VIX if thinking we're going to have volatility. I'm not going, I guess you could say it's naked, Ben, but the thing is, I'm not selling calls, so I'm not putting myself at that kind of exposure. So I don't really hedge. I have somebody else that manages a portfolio for me, so I don't worry about that. I have them do that. So so SPY closed at 330.33. So yeah, tomorrow we'll see if we're bouncing around the 330 level. I might take a 330 straddle. Would you recommend staying away from IPOs where institutional investors are not in on it? That's a good question. I'm not really sure. There are a lot of IPOs now that go direct access. But even when there's institutional investors in it, there's no more real banker, like I said, or the underwriter. They were the ones that supported the stock. There's no way in the old days that we would open a stock at $30 and let it trade down to 28 and the banker walked away. The company would go through the roof, both on the banker and on me, the specials. But any IPO now is at the risk of the market because it's all electronic. So again, I think IPOs as a whole, I like to stay away from them and let the stock settle in for a couple of weeks or a month. Do I always? I don't exercise the option. I'm flat at the end of the night. I'm flat at the end of the night. What is? We had this the other day in my room and I forgot. What is that? Tell me what that is again, Benjamin. Just refresh my memory. The SPACs. I don't know much about them. I can't give you an answer on that. I'm sorry. That I can't give you an answer on. The best advice to give a beginning trader would be, that's another very good question. You know, it's tough because day trading in most of these accounts, you need $25,000 in. to do as many trades as you want. Otherwise, you get limited, and that's very tough for people. I would say the three things I said earlier in this webinar: you have to know yourself, you have to know who you're trading against, and you have to know what the product you're trading. And those are things that take some time to figure out. I don't think you can just go in there and start buying and shorting and doing whatever you want with any stock. Because again, it's going to be more luck than based on anything else if you do that. I would take the time to do a lot of sim trading. Pick a stock you want to trade. Start writing down the characteristics of that stock, the range, the volume, the 30-minute range, the 30-minute volume. That's all very important stuff in all stocks. Start writing down the reference points for it. I mean, I know I'm a lot older than you guys, but a lot of people, I still write things down on paper. Know the high and the low for the last 3 months, 3 weeks. Those are destinations. Those are reference points. Those are really, really important things to learn as you're learning to trade. All those things put together. And I would definitely do sim trading if you can. A good time to buy calls, puts prior to earnings, a week to week. Again, because I trade the SPY, I don't really look at that. I think a lot of sectors are different. A lot of tech stocks, people buy them and they run them up prior to the earnings. So I would say at least a week or two if you're looking to buy the tech stocks. But again, that's not something I put too much weight into, unless you're going to be a swing trader. 25,000 is very steep for a beginner. There's no doubt about it. That's why sim trading is the way to go to start, because once you do trade with a smaller account, you really can't afford to be wrong because you can only take a few trades a week, right? Again, Nicholas, $1,000 is small. Why don't you pick a stock that you like. Do the things I said. Learn its characteristics. Write down all its reference points and destination. Get a notebook based on sell destinations to the upside and destinations to the downside to go long. And then sim trade it. And if you think it's working out, now remember, sim trading is a lot different than real trading, believe me. But if you think it's working out, then open an account with that small amount of money and trade that stock very small. How do I deal with losing money? Not easy. I've done it a long time. I think I keep my cool pretty well in my trading room. Believe me, my room knows when I'm getting hurt. I mean, there's been times I've been getting hurt pretty good. Try to keep my cool and walk them through it, why I'm still long or why I'm still short and what's happening. On the floor of the exchange, there were many times where I would smash a keyboard, believe me. I try to stay away from that now. But I smashed many a keyboard on the trading floor. And when the technician came over and said, what happened? I said, I don't know, it just fell off the counter. But it's not easy. Whether you're doing it for 1 year, 20 years, 40 years, it's not easy. What else was asked here? Any good media source you recommend subscribing to in order to get market insights? I think there's a guy called Shadow Trader who's very good. Shadow Trader is very good. His name is Peter Resnick, but just look up Google Shadow Trader. He's very good. Barron's is okay. Barron's, I see, is they used to be a very bearish publication. I don't know if they still are. Look, to be quite honest with you, and I'm not saying this, well, I am biased. Just follow me on Twitter and YouTube. And I think I give really good insights on the market as a whole. So I think even if you trade some other stocks, knowing what the S&P is doing, I think would be a good guide. And any idea on the foreign exchange market option? I never traded foreign exchange, so I have no idea. My best friend has been trading foreign exchange since the same time as I traded the stocks. We'd have to ask him. He's still in the market, believe it or not. He's still down there. He's in Jersey City still. So, but yeah. You guys have any other questions? I know I've kept you a long time. I hope this helps and is interesting. You still there, Lou? I see
Yeah,
Gary.
I'm still here. I got to
Okay.
say, for myself and on behalf of everybody here, this has been, an incredible discussion. It's been very helpful. I'm sure that the people who are here have learned a lot and are more interested now than they were when they were coming in. It looks like one question that's left is from Enrique Salazar. Says, what do you think about trading Chinese stocks?
I never have. Now but that's more of a factor of because I trade the SPY. But I mean, the Alibaba. I mean, the stocks that are traded on the New York and stuff, the Chinese stocks. I mean, if they're good companies, I wouldn't have trouble trading those if you look into them. So I wouldn't have any issue with that. You guys, you guys and gals are welcome. I enjoy it. Again, my email is paul@camelbacktrading.org. So if you have any questions going forward, feel free to shoot me an email. It's paul@camelbacktrading.org. You have any questions about what we talked about or going forward, and maybe we'll see after the election how this market where it takes us, and maybe if you guys want to have me back, I would do it maybe at some point. My buddy and I we do a bet every year. We wait for the month of January to get market generated information, and then we pick what we think the market will do for the rest of the year. This is the guy who taught me. So we bet dinner every year. So if you want, maybe at the end of January, early February, you have me back on, I'll give you an idea of where I think the market's headed for 2021.
Of course, that would be a great opportunity.
Yeah. Jeff, market profiles mainly the big ones that I look at. Yeah, I would love for you guys and gals to subscribe. It would be great. So, but I appreciate your time. I love seeing good luck in whatever careers you guys and gals are looking towards, and have a great holiday. Stay safe. We're in some interesting times here. This should be a fun week of trading.
Absolutely.
So,
once again, everybody here, seems to have been very excited to have the chance to speak with you and get to learn from you. But I got to say to the team, my members that are still here, it is a rare chance that you get to speak to a person like Paul, who has almost certainly more experience trading on the floor of the NYSE and trading as a career than anybody else in the world, probably in that top 1% of people who stick with trading as a career throughout life and continue to learn more and gather more knowledge. So to have the chance to talk to somebody like Paul is truly a gift. So once again, thank you for coming and speaking to us.
My pleasure. Have a great night all, and hopefully I'll talk to you guys soon.
All right. Thank you.
You're welcome. Bye-bye.